Maybe I looked at your mortgage payments and thought, wouldn't it be great if I could at least write off the interest from my taxes? Now, if you only have a primary residence and you don't do any movements, it's impossible. However, there is a legal tax strategy that's called the Smith maneuver that in a way can help you to write off the mortgage interest. So for that to happen, you need to have home line of credit that is borrowed against the equity in your house. So the second your equity in the house increases, you get more space in your HELOC. That's called a readvanceable mortgage, or another product is all-in-one mortgage, where HELOC and mortgage is tied together. So every time you pay down the mortgage, you can take it out with the HELOC. So once you have the space in your HELOC account, what you do is you take it out and you invest in an income generating asset, maybe stocks that pay dividends, or you buy a rental income property. Because you use that debt, that loan to invest, the interest is a write-off. So for example, if your effective tax rate is 40%, and the interest on the HELOC was $10,000 for that year, you're going to get $4,000 back. Obviously, this maneuver is a bit risky, especially right now when I'm recording this video, where the adjustable prime rate, the mortgage rates are super high. The market is unknown, because for this maneuver to work, you have to make more money from whatever you invested in than what you're paying for the loan. It's basically a leveraged investment, even though you get the tax benefit. The second caveat with this method is, if you're thinking like, okay, I'll just take that money and I'm gonna invest in ETFs from my TFSA account, that's not gonna work, because you can't write off the interest in your registered accounts, because you already get the tax benefit, both in TFSA, say, or RSP. So that's not going to work. The third caveat where I did see people get caught off guard is sometimes when you have space in your HELOC, it is tempting to use it to buy something big, say like buy a car. Instead of paying to the dealership, the financing, go to the bank, you just take it from your HELOC. Now, government is not going to let you write off that interest because you did not use the loan to buy an investment, you just used the loan to buy yourself a car. Perhaps there is a way how to split like what you use to buy an asset versus what you use to buy a car, but I don't know if you want to go into those weeds. Like, it's probably better to just keep it black and white and use that HELOC only for investment purposes. So again, for example, if you have a rental income property, you can offset that rental income with the interest expense and pay less in taxes. So here you have it, one legal strategy called Smith maneuver, how to kind of write off your mortgage interest and get the tax benefit. Till the next time.